and let me butcher this for you, and then you can correct me.
Sure.
But is it like section 129 or something like that?
Close.
Where
You're off by 50.
I'm off by 50.
Yeah, it's section 179.
Oh, 179. Yep. Okay.
And then there's also section 168, which is bonus depreciation. So
say there's a band, they're on the road, and they're at the point now where like, okay, maybe they're going to go open up for an act that's playing amphitheaters, maybe it's a 50-date run. They're not going to be given any kind of bus. They're on their own to get to the gigs.
Yep.
And they're like, well, let's purchase a new van because we need it now, and we're going to need it probably over the next couple of years. And let me butcher this for you, and then you can correct me.
Sure.
But is it like section 129 or something like that?
Close.
Where they
You're off by 50.
I'm off by 50.
Yeah, it's section 179.
Oh, 179. Yep. Okay.
And then there's also section 168, which is bonus depreciation. So ultimately, it comes down to who bought the van, right? Because if it's a group and they have an entity, that entity might want to buy the van. But also, if they're not a group, legally, someone's going to have to buy the van, and
so
they'd be entitled to it.
Let's say they are an LLC, and the one dude gets a wild hair, and he's like, I bought us a van, guys.
Yeah.
Their mistake probably was not doing it through the LLC. Potentially?
Yes or no. So, partnerships, an LLC with more than one member is a partnership in the eyes of the IRS. Partnerships are extremely complex, and they're extremely flexible. And so if one person went out and bought it, we could structure it a number of different ways. If the business as a whole still wanted to share the cost of that, they could do a reimbursement. The business is reimbursing that owner for the payments, and that way we can kind of make it to where the whole pie is even. If that partner wanted to absorb the cost, they could potentially deduct it against only their income as like an unreimbursed partner expense. But just to kind of touch on like the tax law, like the overarching how you actually deduct that, you could do 179. So basically, there's a de minimis amount when you purchase a fixed asset that's different than like a consumable or an expendable, where it's just paper clips or a piece of paper that you're going to use and it's trash. A fixed asset is something like a guitar or a van or something that you're going to use for years. And the IRS basically says you can't just deduct that. So you have to use what's called depreciation. And there's different ways that you can depreciate fixed assets based on what it is and also certain elections. So for instance, section 179 is an election that you can make to effectively depreciate the full amount of that asset in the first year. And then there's, I don't need to get into the weeds of the difference between 168 and 179, but effectively there's ways to deduct all, if not, or a portion, if not all, of fixed assets in the year that you buy them.
Well, if there's any artists out there or bands listening, and you just bought a van, I hope you're listening.
Yeah.